Welcome to the GCV Weekly Briefing Podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses and policymakers. I'm Matthew, and this week we're taking a look at Britain's labour market, continued weak GDP growth, the $1 trillion rush in AI, and Goldman Sachs' interesting move into alternatives. After months of turbulence, the UK jobs market finally appears to be steadying, though it's still at a fragile position. The unemployment rate rose to 4.8% in the 3 months to August, up slightly from the 4.7% seen in July. That's a touch higher than many in the city forecasted, which expected no change. Meanwhile, HMRC data showed about 10,000 fewer people on payrolls in September. The good news is that the rate of the decline does seem to have slowed compared to earlier this year. Liz McKenna from the ONS described a levelling off in hiring activity, suggesting the worst of the correction may be passing. But it's not even across the board. In fact, the single month unemployment rate for August hit 5.3%, the highest seen since 2020. Another challenge is data reliability. The ONS Labour Force Survey has been struggling with falling response rates, raising questions about how accurately policymakers can read the jobs picture. Alan Taylor, a member of the Bank of England's Monetary Policy Committee, summed up the tension neatly. He said, "In an economy with rising unemployment, weak demand, wage settlements will be pushed down, and wage-led domestic inflation will not rekindle an upward spiral." That perspective highlights how the Bank of England is viewing inflation risks very differently now compared to just a few years ago. While the UK economy steadies itself, across the Atlantic the tech sector is anything but calm. The global AI infrastructure boom has reached extraordinary levels, with OpenAI reportedly securing around $1 trillion in deals this year alone, according to the Financial Times. A big part of this is a $300 billion agreement with Oracle for computing power, part of a $500 billion project called Stargate. It shows how much of this race is about access to chips, data centers and processing power, not just about software. The web of deals is frankly striking. OpenAI has partnered with CoreWeave, Broadcom, Nvidia, Oracle, SoftBank, Microsoft, the list goes on. Nvidia alone has backed OpenAI with $100 billion and agreed to buy over $6 billion worth of CoreWeave's unused capacity. It's a closed loop of mutual dependency, where the same few players fund, supply and lease infrastructure to each other. Not everyone is convinced it's sustainable, however. Bain & Company estimates that AI firms would need $2 trillion in annual revenue by 2030 to justify these infrastructure costs, meaning there's potentially an $800 billion shortfall. That's raised expectations to past tech booms, when growth expectations outpaced financial reality. But others say that this time is different. CoreWeave CEO Mike Intrater offered a clear defence, saying there's nothing circular about that. It's a fundamental infrastructure build-out that's taking place. When you have such massive scale investment into infrastructure, it is not unusual to see partnerships as people try to serve infrastructure to the customer. Back at home, the latest ONS data shows the UK economy remains stuck in a low growth pattern. GDP rose by just 0.1% in August, helped mainly by a 0.7% rise in manufacturing output. The July figure, however, was revised down to show a small contraction. Looking over the 3 months to August, the economy rose 0.3%, only a marginal improvement. Services, the biggest part of our economy covering retail, hospitality and finance, were flat again, and economists say uncertainty around tax policy may weigh on business activity into the winter. The IMF has predicted that Britain will be the second fastest growing major economy this year, but also G7's highest for inflation, largely driven by energy and utility costs. Ruth Gregory of Capital Economics summed up the challenge, saying there's little reason to think GDP growth will accelerate much from here. The disruption caused to the auto sector by Jaguar Land Rover's cyber attack probably meant the economy went backwards in September. And finally, away from the macro headlines, one of the more interesting moves in finance this week came from Goldman Sachs. The firm has agreed to buy Industry Ventures, a San Francisco-based investment manager, for just under $1 billion. The company deals expands Goldman's reach into fast-growing venture secondaries market, where investors buy and sell stakes in private companies or funds. It's a niche that's growing quickly as startups stay private for longer and IPOs remain limited. Industry Ventures manages about $7 billion in assets and will now sit within Goldman Sachs' $540 billion alternatives division. The acquisition builds on a minority stake Goldman's first took back in 2019, so this is more about deepening a partnership than a takeover. Goldman's will pay $665 million upfront, with another $300 million tied to performance throughout 2030. CEO David Solomon has described asset and wealth management as a key strategic pillar, a way to balance out the bank's more volatile trading revenues with steadier fee-based income. This week's briefing saw two key areas of our radar, with data points focused on the UK economy and investment activity both in large and small. The UK economy remains on a similar trajectory to recent months. With the budget now a week closer, attention turns to whether it might offer an indication of a shift from stagnation towards more sustainable, longer-term growth. On the investment side, the ongoing circular flow of capital within AI and tech sectors remains fascinating. Many economists believe this pattern contributes to a cycle of artificial revenue growth, inflating market capitalizations in the process. With the Shiller PE ratio for the S&P 500 now at its second highest level since the peak of the dot-com bubble, investor confidence has certainly started to waver, though it's not saying a panic is setting in at all. At the smaller end of the market, it's interesting to see major institutions like Goldman Sachs making moves into the alternative space, particularly through venture capital and startup investments. In this case, though, it's in a slightly different format that could pique the interest of more investors. Looking ahead to next week's briefing, we'll be featuring fresh data from the ONS, including updates on public finances and CPI data. Thank you for listening. I'll catch you next week.